Jim Matush, Trinity Wealth Advisors, here with Holly Breuer from Prosper
Prosper.
CPAs. Just a great firm that we enjoy working with because you're so proactive, because you look forward. And this is a good example. So, those of you that are tuning in are looking at, what can I do before the end of the year? Let me inform you on what has people, accountants like Holly, stand out head and shoulders above the rest. Probably, Holly, my estimation, I'd be interested in your perspective, is that 75% of accountants are what we call compliance accountants. They're doing the tax return, they're getting the return in by April 15th. People are conditioned that by January 31st, they get all their 10-9, all their information together, all their business numbers. They're scrambling for March 31st deadlines and April 15th. But in any event, they get all this stuff together and then they look at their tax bill and say, do I owe more or do I owe less? Proactive accountants are ones like yourself, Holly, that look at things before the end of the year and then say, oh, what could I do? Oh, how could I maximize this tax bracket, this low tax bracket? How could I get more of a deduction? How could I defer income? So, those are the things we're going to be talking about today, jumping into with last minute strategies that can save you money this year. And a dollar saved is a dollar earned. It's better than making an extra dollar because you got to pay taxes on an extra dollar. A dollar saved, you've already paid taxes on it. So, in any event, let's jump right in.
Okay.
Holly, give me a little background on Prosper. And I just love you guys' story and how you've come from behind someone making it on your own. Just as much of that little story that you'll share, I would appreciate. I think our listeners would enjoy that.
Sure. Prosper, we just celebrated our third anniversary. And so it was a group of 10 of us that started Prosper 3 years ago. We knew each other from other firms. St. Louis, I love CPAs and I love the business community in St. Louis. We know each other all around. And so we started a full service CPA firm here in Chesterfield. And the team has known each other, though our administrative director I've known for the 23 years I've been in this business. Taylor Lukemeyer, my partner, that's our tax director, I've worked with on and off I've known her for 17 years, fresh out of college. So it's a group that knew each other already. We love it. And what we wanted to do was try to be so we don't intend to be massive. We're trying to be a kind of a more niche firm. There are now 14 of us, and our goal is to have more high level CPA tech, everything here for you. Only it's a group of us that want to be on the phone, talking to our clients, helping our clients. We don't want to just work with the person to get something in the door and get the tax return out the door. So we like to work with business owners and high net worth individuals and folks that are really have a lot going on that would like our assistance, that need
And
the help.
Holly, you experienced firsthand as firms that you were with grew, developed, got big, sold out to the big firms, but wanted something different. Speak a little bit to your why.
Yeah, that in to each their own. There, some of theirs, they had a great plan on their own to do that. It just didn't suit me. And our intention is to go to the second generation. So our directors that have started, they're probably 13, 14 years. And like I said, Taylor, 17. And the day we started, I said, you're my retirement plan. I plan on when I retire in another 12 or 13 years, Prosper will stay. So the goal is that we have set everything up for the group to buy Prosper from me, and have the same group here, the same team that's in place will be in the team in place when I retire, and they will be my partners taking over.
And all of that with kind of a service mentality that didn't you share how you were experiencing as firms got bigger and went more regional and went more national in scope, you just lost the personal service level of approach with clients. We call our clients a family. It's like we consider ourselves a family, much like you. Prosper and Trinity are very similar in approach to who we are able to serve as our family, as well as the team that we all know each other. And we just hired someone this year. We're fixing to hire another person. And it's like you got to fit in with the rest of the family because that was the service
Yeah.
model I think you were talking about wanting to bring back to St. Louis. And you don't find a lot of firms that have the bench, the ability to help people, and yet the ability to come alongside of them proactively. Again, we were discussing that's just not so common as you would think it ought to be.
Yeah, I mean, and again, I love CPAs. They're all doing what they can. We tried to set it up so that that is the way that we function. So we're a little bit selective about our clients as much as we are about the staff that we have. And the team is important, and everyone that is working together gets along really well. And when we hire, multiple people interview, go to lunch, get to know them. And so we make sure that we hire folks that either we really already know well, or the interview process is very long, so that it is somebody that wants to serve, that does want to be on the phone, that wants to speak with the clients. That it's going to be a rough road at Prosper if you're somebody that wants to just sit with your head down staring at a computer all day.
I know
Yeah.
people often say, I like my person, they know it all. And I say, really? We're not like that. We
Yeah.
believe in a team approach where each person is hired because of their specific background, their interests, their ability. Some people are good at follow through, some people are not. And therefore, I have people that support me in that area and stay in touch because that's one of the most important things. Let's jump right into
Righty.
year end. What are the last minute things? I know you were sharing with me how there's either deferring income or accelerating expenses. Jump into kind of the mindset that you use, Holly, with looking at a picture, whether it be for the first time or client year after year. What do you do?
So, year after year, I think one of the biggest things that I always talk about, we did just have a big piece of legislation this year, the One Big Beautiful Bill Act of 2025. I call that the O triple B. Everybody calls it something different. I was at a conference, they called it the OBBA, and I'm going to go ahead and not call it that. That passed in July. What that tended to do was extend some things. And so we got back into making sure that if you were buying something, if you're a business owner and you're wanting to get assets, we're writing most of those off. There's a big chance that bonus depreciation back in, we're writing those off. That was a big one. They added some changes to some non-taxable income that I'll talk about in a minute when we talk about it at the very end of the year. But it was an extension of a lot of that. So we've been working really since July, trying to get everybody ready for the rest of this year. The good news is we were worried that a lot of things were about to phase out, and 26 was going to have all kinds of much more income. So we were trying to either pull some income into 25 because the deductions were gone in 26. And the good news is that is not happening. So 25 and 26 will look very similar. So if you are a historic business and things will be similar year over year, we might want to look at a 2-year plan, 3-year plan, as opposed to let's get everything done into the last 2 weeks of December. But if you are looking, this is a bigger year. Some of the things that we're looking at right now, I'm always big at looking at, you brought up a DAF, bring a donor advised fund. That is a charitable donation. For those of you that don't know exactly what that is, it's a pretty easy one to set up. Your wealth advisor can get it done for you pretty quickly. The contribution to the donor advised fund is the charitable donation itself. When you are donating, and one thing that I see a lot of folks doing is donating appreciable stock. So maybe it doesn't have a lot of stock basis, but it's got a lot of market value. And you'll get that charitable donation for that stock into the donor fund. What happens is inside that donor advised fund, it grows and that growth is tax free. And then that growth can be contributed, donated to a charity of your choice. So you advise, that's why it's the donor is advising. You can still say where you want the money to go. But if, say, you normally give $10,000 or $15,000 a year to a donor advised fund and you have the cash, you could give 5 years worth, say a $50,000, $70,000 donation, something like that. And then that's that much more deductible in that year. You get that big donation in the year that you contribute to the advised fund. Now, once you contribute out of the advised fund, that's no longer deductible as a charitable donation. So that's why you try to combine everything as a kind of a one large lump. And it's great at the end of the year. You just got a customer paid. You didn't think it was going to happen. Suddenly you've got a lot more income. Something came in and now you're trying to figure out what to do with it. That's always a great one. I'm a big fan of a donor advised fund. I'm also a fan of that for 25 because in 26, we're going to start having a floor to charitable giving. So there's going to be a 0.5%. I want to say 0.5%. And I'm going to pull up my PowerPoint that I had made to make. Yep, it is the floor is a 0.5%. What that means of your AGI. And what that means is if you have an AGI of $100,000, and here's me not being able to do the 0.5%, right? So the first $500 charitable donation is not deductible. It's above that. And that's a new thing that will be instituted, and that is in 2026. So if you're trying to decide, things are going to be similar 25, things are going to be similar in 26, should I give now? Go ahead and give now. You'll be able to do that, especially if your AGI is much higher than that. Floor just rises. So it's 0.5% of your AGI is not deductible, even when you're giving to a donor advised fund. So that's one thing. Right now, people are also looking at if you have, especially if you are a sole proprietor, you've got maybe a Schedule C on your personal return. A SEP is always a great plan. It is a retirement IRA, basically, but you don't have to file a lot of the forms that you generally do for if you wanted to do a 401k or if you wanted to do something like that. If you have employees, they are affected. So we'd want to calculate what that looks like. But oftentimes it's a person by themselves and they can deduct 20% of their self-employed income. So it's a good way to then contribute to retirement. You can also hold off and contribute later. So you don't have to contribute by December 31st. You contribute by April 15th when you file, if it's on your 1040, or you can extend your tax return and not put in your SEP until October of next year, and you still get the deduction in the current year.
But you do need to have that SEP set up by the end of the year, don't you, Holly? Or can you set that up in April?
You can set it up. You don't have to have that set up by the end of the year. You just have to have it contributed by the due date of the tax return. That does include extensions. So you can wait
so
until
you can
October.
push that off until October of next year.
Yeah.
Wonderful tip that
Yeah.
again, what you're experiencing for those of us joining us on the webinar, wow, we've got a great group here. What you're seeing is how a CPA looks at your picture before the end of the year and how can I get more deduction? We all think that, yeah, my CPA is supposed to be doing that naturally. But I will tell you, as a wealth advisor coming alongside people, I will say, when do you do your tax planning? And people say, I do it in April, or I file an extension and get it done by October. And I go, if you could look at this before the end of the year, like you were talking about depreciation schedules, DAFs, bunching deductions. so that you get more in one year. I love that DAF perspective of being able to get the deduction this year, but maybe use that as your giving pocket for the next 5 or 10 years. So many people do charitable giving just out of cash, and they're
Right.
missing that ability to gift an appreciated asset, a long-term gain. You don't have to pay the taxes on it, which
Mhm.
is a wonderful skip, but you get the deduction on the full amount. Keep
And
going, Holly. You're throwing out some great ideas. What are some of the other things that you look at?
yeah,
Accelerating income, I'm sorry, accelerating expenses,
yeah,
deferring income.
I wanted to tag off just to say, first of all, I think I said 20% on the SEP and it's 25. Sorry, it popped in my head and went, fix that. It's 25% actually of your self-employed income. Now there are limits. Talk to your CPA. Make sure that
On the SEP, you're talking
on the
about the
SEP.
qualified
Yeah.
plan. Yeah, up
And
to
then
25%. Which is
yes,
pretty considerable.
it is. And it tops out, but each year it grows for cost of living. But I wanted to make sure that I said 25. And the other thing that I wanted to add on the DAF, standard deduction is pretty high right now, especially so if say you're an older person, you're going to have a standard deduction of I think it's 31,000 now for a married filing joint, that's considerable. There's also a $2,000, even if you use standard, there's $2,000 charitable deduction that you can take, and that's above the line along with your standard. So if you did 1 year with a big DAF, the next year you're still going to get back, say you go back to standard, and then a $2,000 if you get something out of pocket to somebody too. That's just a way to think about, you're still going to you want to use as much as you can on a big year so that going forward you can go back to standard and still get a lot of deduction that way as
That
well.
has made a huge difference in a lot of people's lives, because the deduction being something that helps us, that standard deduction, but needing to cross that to get the tax benefit, something that is really makes sense with bunching, putting them into
Yeah,
1 year, which is again why that DAF comes into the picture.
it does. And another thing that folks might want to think about too is the SALT. That, remember, we have that state and local tax deduction.
Oh,
It's changed. And so it's been $10,000 a year. Now it's gone to 40,000. However, there is still that SALT deduction still phases out for folks. And it might have been, okay, the cap was 40,000. It's now $40,000 instead of 10, but if you have an AGI over $500,000, it phases out until it goes back down to $10,000. So if you are a high net worth individual, you may be phased out in the SALT cap anyway. And so you might either be looking at a standard deduction or a large charitable to get you over there to be able to deduct. So that's another one when you're talking about the DAP. When you're talking about speeding up some expenses, that the one that I talk about that's pretty easy, like I said, is assets. If you do have, it's any asset that has a class life, a life of less than 20 years. That's most assets. Really, the only ones that kind of go over that. There's some specialty assets, but really it's commercial or residential real estate, the building itself. Like that is really pretty much most of it that doesn't fall under this bonus depreciation. It's new or it's used. And there's no limit the amount that you buy. Most of that, if you do need something around your office or you need something you need something around the business at all, chances are there's a good chance I'm going to be able to write most of that off. That's one to think about. If you were looking at it in January and you want to do it now and you needed the deduction, it's a good deduction for you to have. Another,
December. Yeah.
yeah, another thing to think about with folks is a lot of times they're thinking about the use of cash. How am I going to use the cash? A note, a line of credit, a credit card, all of that is, for the IRS is concerned, same as cash. So just because you're buying it using your line of credit or putting it on a credit card or do something like that, it's still a deduction in this current year.
Wonderful point. Credit card gets you the deduction in December. And conversely, income. Don't you need money out of your IRA or something? Don't go pulling it out December 20th because
Yeah,
that's taxable this year as opposed to next year. But keep going.
correct. That
These are
and
good.
that's a thought too. And one thing I like to always say, one of my big points that I make with my clients is regardless of the big tax legislation that's happened, and really I actually ran a timeline of some tax legislation, and since 2015, I think we've had maybe 9 large pieces of tax legislation. So first of all, for any of you that are out there that are like, why don't I know all of these things? You couldn't possibly, right? It's just by the time you learn it, we learn it, the next one is out. But in all of that, one of the things that I try to tell, especially business owners, is the entity type you have the right entity type. There's a lot that you can protect yourself from ups and downs of legislation if you are in the right type of company. Is a C Corp and S Corp a partnership? It is what is best for you, for the kind of company you have, the kind of ownership, how you use your cash. And then secondly, is cash basis or accrual basis for tax purposes only the most advantageous for you? I am working with a client right now, and it wouldn't be the first one. I'm often working with clients that have a lot of accounts receivable because they're growing, they're busting at the seams, and they don't even know. A lot of these are new clients. They don't know if they're going to collect all of that AR. But for tax purposes, they were currently on the accrual basis. And so we're taking them, we're going to change them to a cash basis, and the change to their taxable income is dramatic, like 7 figures dramatic. So we're really, are you set up in the right way? And those are things that we can be looking at the end of the year, trying to see what it is for the year, not necessarily the type of entity. We could be looking at it for next year, but are you really, for tax purposes, set up correctly? That is what will protect you.
Another reason why your CPA is such an important part of your team for helping you navigate with this sea of changes constantly. I love the Tax Simplification Act way back when Reagan came through, 76,000 pages. It's going to make things simple, right?
When I think we're going to talk about taxes or tax planning, Jim, I know it's going to be a good time. So I'm not that person. I think it's fun to do that, but not
let me
everyone does.
interrupt just for a minute because I want to, for those of you, use the chat box if you have a question. So we want this to be interactive. If you've got a question, I forgot to announce that at the beginning, but this is two-way. And if you have a question, use that chat box and I will bring in your thing.
Not the chat box, it's the question and answer box.
The Q&A box. The Q&A box, I have just been corrected by. Okay, there is a chat and there is a Q&A. Oh, use that for any question and I'll bring those up for you as they come up.
Okay. A couple of the things I wanted to point out, Jim, just that I get asked a lot about, just for folks that either there's this no tax on tips and that no tax on overtime.
Yes.
Wanted to explain that a little bit too. I get asked that a lot. So one of the things so the no tax on tips is up to $25,000 per taxpayer. Okay. So if it is, let's see, I wanted to make sure that I'm saying this right because it expires after 2028. So you really only have that 2025, 6, and 7. So for the next 3 years, at least right now, this is what we have. So it benefits, like I said, per taxpayer. And it is, the occupations are already set by the IRS. Some people had asked the question, what occupations fall under this? There's going to be a list from the IRS. It was supposed to be out in October. I quite frankly haven't seen it yet. It could be out and I missed it, but it is based on the codes for specific types of industries that would have already gotten tips before 12/31 of 24. If you are available, you've gotten tips in the past, maybe it's for a hairdresser or restaurants or delivery services, those kind that are already have been given tips. But if you want to say some of this was tip income and you are a CPA, it's not going to work. It's got to be something that's already there. However, if you do have that, you should be able to, there's already a tip line on W-2s. So
CPAs don't get tips.
we don't get tips.
Wealth advisors don't get tips either.
Yeah.
We're in the wrong business here, Holly.
Nobody wants to give us tips, but and you know what? That's okay.
I get tips all the time, but they're stocks or horses. I don't know. I don't understand this. It's not saving me any taxes. But do you have to track? You mentioned some dollar levels. Do you have to track what your tips are? Because
so
the
other side is the overtime. And I think it's interesting because the overtime is 12,500 per person or 25,000 for joint filers, where the other one could be 25,000 a person. It's interesting to me because I feel that just in my experience that businesses are great at tracking overtime. That's something that they definitely track, but there isn't a line item on a W-2 for that. So they're still trying to figure out how are they going to disclose that breakout of the overtime for the employee. And then on the other side, tips have a line item on the W-2, but they're not particularly handled well necessarily in many businesses.
No business keeps track of that. So is that the honor system? And
I would suggest to people that if they've never had tips that they've disclosed and paid tax on, and suddenly they have $25,000 in tips for the next 3 years, and then they don't have tips again, there might be an issue. So they might want to it is an honor system. I say that really most people are honest, and when they have tips, they disclose them and they pay their taxes on them. And what some restaurants do actually is they do a percentage or of what they think it is, and they'll get a tip credit for disclosing some of that percentage. So most businesses, the ones that they're not particularly set up really well, are the ones that are cash, a lot of cash. A lot of delivery services in that anymore are electronic. So I think that's more and more the tips are being paid.
Restaurants through credit card.
Yeah. A lot of it is through a credit card.
Yeah.
So those are ones that people, they'll already naturally have the less income just because of those two things. Another item for personal ones that I've been asked about a lot is the car loan interest deductions. That's new this year. The car has to have been purchased in 25 or later. This is another one that phases after 28. It is a car that has to have some of it has to be put together in the US, meaning it doesn't have to be a fully US owned business. It doesn't have to be like a GMC or a Chevy. You could have a BMW, but that the BMW is the final put together is in one of the factories in the US. So the interest on that loan that starts this year on those type of
25 or 26?
5.
25. So
25 starts that.
There will be an interest deduction for those people. Like I remember in the 80s when you were able to deduct interest on consumer
on your car
loan. Yeah. Doctors that had, and I'm like, how do you get all this debt? And that was when you paid a fortune for debt. But
so it tops out at
that's
10,000.
for 25. That's a good one.
So 25 to 28. It tops out at 10,000.
If it's a US made car.
Yes. Final assembly in the US. That's the part. So that means, like I said, the final assembly has to be here. So it doesn't have to be fully assembled. It could be, which is a lot of cars, quite frankly, are. They even might be started somewhere else, but the final assembly is in the US. So most cars are probably going to fall into that. But if you do have a car that's German made or some other, you want to make sure that the final assembly, I would think that they probably would, that's a selling point. So they're going to know. You can ask. And it has to be that it is a vehicle that is meant for licensing for the road. And it's under 14,000 pounds. So we're not looking at massive trucks, commercial trucks, and we're not looking at a bicycle and we're not looking at a golf cart. And I know people are driving those on the streets more and more,
You're
but
demonstrating your creativity, Holly. I'm
but they're not,
assuming
yeah,
you've been asked
you're
these
not deducting
questions
that.
before.
But you're
Oh,
not
Holly, I've got a question here.
sure.
This is a good one from Bill saying, could you explain the marginal brackets and why that makes a difference? So I assume that's about maximizing the lower marginal brackets and probably, I don't know, Bill, are you probably looking at IRA ways to take advantage of the, okay, please explain the marginal brackets.
So what marginal brackets are is, and the O triple B did extend. So the TCJA, the Tax Cuts and Job Act of 2017, during President Trump's first presidency, was a lot of the O triple B extended a lot of the stuff that happened in that one. And one of them was the lower bracket. So what they are is you have to get a certain amount of income and go over that before your tax percentage increases. Okay. And that's not your effective tax rate, because your effective tax rate, it takes into account other credits and other deductions. But your marginal tax rate is to say anything under $103,000 or something. So I pulled up my rates so that I have them in front of me. Anything that is between 48,000 if you're single and 103, somewhere around there, is 22% marginal rate. That's if your AG or your taxable income is that. If you are married filing joint, the reason why these have been extended is they're lower. It takes a longer time to get to the top rate. It is good because things like if you have IRA and you've got required minimum distributions and you decide to give a QCD, meaning a qualified charitable donation. So instead of taking it out of your IRA, taking the money and then putting it into a charity, giving to a charity, you have a required minimum distribution and you send it directly to a charity. It doesn't touch your AGI at all. And so some of these brackets, you can stay a little lower when you keep your AGI and your taxable income lower. So I think
Again, the importance of proactive planning. I know when we get a client, we load their last year's tax return into our system that tells us, oh, here's where your brackets are. That's a great question, Bill. And
yeah,
you want to take advantage of pulling out
right.
that if you've got up to, what was your example, 100,000?
So yeah, I was saying, say you're married filing joint, and that's a good one. And now we're at 96, between 96,000 and 206,000, you're in the 22% bracket.
Okay.
So you right now are at $150,000 that you think that you've got taxable income. Do I want to take 75 or I want to take 60? Then we can say, okay, you're going to push yourself to the next bracket for that next nominal amount of money, but that does push you to another bracket. So it does matter. And that's a lot of times people look at that. They also look at, and I can send you some more information, Jim, that we can send out to everyone. One of the things that I think that people don't think about when they're rolling, and Taylor Lukemeyer, my partner, is really great at this, is caring about how that affects Medicare. Sometimes your Medicare benefits get affected when you're older by, say, rolling to a Roth IRA or causing yourself to have a higher income. And I mentioned rolling to a Roth IRA. If you have a year you're in the middle of a bracket, your lower income, say that year, or you're just smack dab in the middle of a bracket and you're wondering, is this a good year to roll my money over from a traditional IRA to a Roth IRA, which basically you pick up the income in that year. And oftentimes it's still a great savvy move, because by the time the way that the stock market has been for decades now, it makes sense oftentimes to put it into a Roth so that when you finally take it all out, that growth is coming out tax-free.
Tax-free, that Roth conversion,
For the Roth
that-
conversion,
that's, by the way, Will, thank you. And we'll take
Yeah.
that. Let me just announce that
Sure.
now. Anyone that wants that information that Holly just mentioned, we're going to send that out to you. So mention
Good.
that in an email request. We'll give out our emails and our contact information, but happy to send that out along with a copy of this for those of you that might have missed something. But keep going, Holly, you're on a roll.
Yeah. But yeah, so when you look at, that's one of those times when you want to say, okay, it's again, I'm in the middle of a bracket and it's a lower bracket than maybe I'm typically have. And I'd like to do something like a Roth conversion. Is this a good year to do that? And you could say, yeah, for this amount of money, yeah, this is you're a little bit lower than maybe you normally would have been. And you're still in the middle of that bracket. So let's go ahead and take advantage of that, because next year might be a big year, or maybe next year is going to be a big year. Then this year, this is when we talk about pulling the income into this year. Next year, I know I'm going to wrap up this big construction job, or I've got something that's happening that I know that 2026 is going to be a big year. So is there something I can do in 25? In 25, maybe this is the year that you do something like a Roth conversion, or you sell some stocks that you know you want to sell, but it's going to be a high capital gain on it. Maybe this is the year you do that because you're at an overall lower tax level than you're going to be in next year. So that's another thing you want to
Should
look
go
at.
without saying, if you're looking at a sale of a stock, consider either that DAF contribution, or if there's a gain, if there's a loss, you want to take that personally. Do not put a loss into a DAF. But
Correct.
secondly, consider waiting until January. Don't want to let the tax tail wag the investment dog. But if you can wait until January 1st, then you're into a whole new tax year as opposed to 25. So another end of year thought.
In the state of Missouri, if you are a Missouri resident watching us today, the state of Missouri has removed tax from capital gains. So that's another thing that you're looking at too. And that starts in 2025.
Great point.
It's looking like this isn't something that'll phase back in. At least that's not what I'm saying. So I'm not saying hurry up and do it in 25, but if you are trying to figure out, hey, I might want to do that, but what's my tax consequences? Keep in mind that the Missouri 4.7% is not going to apply. So that's another thing to think about when you're trying to sell a stock. Again, I'm not I don't do wealth advisory. I don't pretend to. And there are too many people that are incredibly good at it that I don't need to.
That's why we work well together.
Yeah, that's because I stay in my own lane. I'm not in the middle of that. But if that was something you were discussing and you came to me and we wanted to talk about what are the tax consequences and do I have to do it in this year versus next year, one of the things we could say is Missouri now has made that change. So you don't have to worry about it this year versus next year for the state.
Very good. Very good. Okay.
I am talking on and on, Jim. Do you have any questions too about any?
No, I just,
Okay.
and any other tax saving opportunities still available? I had somebody ask me earlier about the tax credit opportunity zones in Missouri. Are you familiar with any of that? Are you working with any clients that are involved in any of that?
I don't work a ton with them. I do know that it's not an end of the year planning opportunity zone. That is another thing that extended with the OBBB, the opportunity zone. And right now, a lot of those are controlled federally. And so the states have say, and they're going to have more say as well. But the opportunity zones, if you are looking to take your capital gain and hold it and contribute it to an opportunity zone, you really want to be thinking about that before the sale of what, that's going to give rise to the gain. So that one's not a great one for me to suggest. I'm thinking at the end of the year, we can send out some information about opportunity zones.
That's really a long-term yes.
But that really is something you want to be thinking about it had, as you're thinking about, you're going to sell something that's going to create this gain that you want to
Long-term
use for the
going
opportunity. So
forward. Yeah.
it's definitely a long-term planning goal, and not necessarily something that I say, hurry up and run out and do that. It's available to you, but you do have to leave it there for a while. And so it's the gain. You don't just stick the money somewhere and then in a month get the money back, and because it crossed 25 to 26. When you invest into an opportunity zone, there's a lot of rules that happen with that opportunity zone and how long you leave your cash there as well in that new opportunity. So you want to think about that far in advance. That one isn't one that you want to just throw down and say, I think I want to do an opportunity zone before the end of the year.
Okay, I've got a question here from Tom that talks about, I had mentioned something, one of our flyers had talked about coordinating your planning with your faith and your values. So what did you mean by that? Here's an example. There are many people that, for example, Christians tend to donate 10% or tithe. And that comes into this perspective here where what Holly, you were talking about earlier is bunching. If you are going to, let me make it easy. If your income is $100,000 and you're going to give 10% a year, so that's $10,000. What you might do or consider to reach that bigger deduction to cross is do 3 or 4 years worth of donation into that DAF. You can set that DAF up by year end, but put that appreciated stock, and you know you're going to give. And we've run into this all the time, people that just give out of cash. But if you take that stock that may be worth $50,000, then you've got your giving pocket now set up for the next 5 years or so that anytime that you want to give, you give out of that, and you've already taken the deduction back in this year, which got you the tax savings earlier. So that's what we mean by matching or aligning your faith with your values, with your giving for additional tax savings. Any other examples that come to mind for you, Holly?
I think that when I think of, and that's why I like working with you as well, Jim, because that thought process permeates what you're doing. And I think of that way as well. I don't feel like you need to be aggressive. I don't feel like you need to do things that are on the IRS's radar because it's just shy of fraudulent. I think that you can do things. I think if I have a business stance for what you're doing, and this is actually what you do for business, and there's a tax deduction to be had, I may not be aggressive, but I'm assertive. I'm strongly assertive for you. And if you do the things in the planning and do the things in the way you should, I can still get you the bigger deduction, probably a larger deduction than you were getting with the person that was slapdashing together something, and then also maybe being a little bit shady while they're at it. And there's no reason to be, so that you can, I think, as long as you are harnessing and utilizing all of the tools that are given to us in tax law to make sure that you're getting the most deduction, you can be strongly ethical and being the way that you want to be as a business owner, as a taxpayer, and I still like to win. So I still like to make sure that you are not prepaying and overpaying the government for taxes, that we're still making sure that it's done right, but you're still living your faith.
We call it stewardship. We've all been blessed here, even just by living in America, but we've been blessed. And what you've been blessed with, you want to steward wisely, and how you align that going forward. Here's a great example that I'm actually working with now. I have a client that's trying to sell his business, and it looks like it's going to be at the year end, and it's a multi-million-dollar business. And that person says, we want to give money out of that, but boy, we're not going to give In this situation, it was a significant six-figure gift as a percentage of this total multi-million-dollar sale. And the thought was, okay, let's put that into the DAF, or even better, this particular sale might get extended into next year, which I'm hoping for, which gives you more time to plan with giving an illiquid gift, which gets a little more technical. But if you were to gift a percentage of that business interest into a charitable entity like a DAF, you can actually get that donation before the gift, before the tax, get that as a tax deduction against this. And for example, in this case, this is a significant six-figure tax deduction that will likely happen at the end of the year, last minute, because that client set up a DAF and has it set up and ready to go. And all he has to do is put the money in before the end of the year, and assuming the business sale takes place. If the business sale moves into or past January 1st, then there's a whole year to plan and potentially put that business interest into the DAF, avoiding the gain on the sale and getting additional deduction. So I hope I'm not confusing, but if you're one of those people that's looking at the sale of a business, come and see us before you sell the business, before it's inked is the technical requirement. Valuation has to be done, but we know lots of business people that deal with this kind of a transaction, and that can more than pay for the expenses of putting something together like this, and get you a nice handy deduction against that big gain that you're in horror expecting.
Yeah, you know what, I was just thinking about when you said bringing in other folks too. One thing that I just thought of that can happen into the next year, but still can affect you now for people that own real estate. One of the things, especially commercial real estate, is a cost segregation study.
Cost segregation, talk about that a little bit. Oh, we're close to time,
I
but
know.
make
All right,
sure and hit that cost segregation. That's a good one.
It's a quick one for you. You've got a building, and it's when I said earlier about, hey, almost all these assets I can write down, and except for basically the box that is the building. So those are residential is 27 year and commercial is 39 years of depreciation. So they're not subject to bonus. But what a cost segregation study is, engineers come in and they break that box down. So you've got a building and it's $2.5 million building. It's depreciating for 39 years because we all have nothing but time to watch that thing depreciate for 39 solid years. And the engineers come in and they say, even if you've owned it for 5, 6, 7 years or longer, some of the things are depreciated, it's just rolling depreciation. And they can come in and say, yes, except that this electric is used for these things. And so it's really 5-year property. And these walls are really 10-year property. And they take it below that 20-year threshold, which makes it eligible for bonus. And you do it in the year that the cost seg happened. And now bonus is 100% write-off. So I'm in 2025. I have a building. It's the end of the year, but I've got a lot of depreciation left. Maybe I bought it 3 years ago and I bought it for 5 million. It's just been depreciating for 39 years. A cost seg can go into next year, but it is applicable to the 2025 tax year. They just have to get it done before you file. So they can break out. I have seen some that the building was an $8 million building. They broke out maybe $1.5 million that we wrote off. The other piece is that while they're there,
big savings.
It's really big. I've seen really big savings, and some
cost
I've seen
segregation.
Cost segregation study. We don't do those, but we do work with some. I'm sure you know some too, Jim. But I work with some folks, and they're pretty. And cost segregations used to be expensive, and they're just not anymore. They could be for an $8 million building, could be something like $14,000 or something, and they could turn around and get you. I've got one that's right now, and the building has been, they've had the building for over a decade, longer than that, and they've still gotten out of this another $600,000 or $700,000 deduction.
And the same thing for R&D tax credits. Do you
Yeah.
work with those, Holly, or do
We
you?
work with them. So some folks that have like a simplified, especially ones that they work with, we will do those in-house for them. That's the simplified, meaning it's probably wages. We know this person and their percentage of their time is this. But we also work with some folks that put those together. And then it's a form 6765 that goes in with the tax return. And we do that, though. We can do that piece with them. So those are things that also happen next year that just like that SEP that doesn't have to be contributed until next year. The cost say can be done in 26, but we can deduct it on 25's return. The R&D credits can get done. That stuff can happen in 26 and then can come back in 25. So there are some things that, holy cow, it's already the 10th of December and there's no way I can get an engineering crew and I can do all these things, but you can still get the deduction for this year if it's something that you think you need.
So the key is, folks, I'll wrap up. You want to have a proactive CPA looking at your situation when you're into the more complex business scenarios, when you're into higher net worth scenarios where it really pays, it doesn't cost you. Someone that's going to look at your picture before you get to the end of the year as opposed to after. And as Holly mentioned, there are several ideas that will work afterwards. Thank you for joining us today. If you want to reach us, Jim Matush, Trinity Wealth Advisors, jmatush@trinitywealth.com. And our number is 314-966-0033. We will put this in the summary. Holly, go ahead and give your contact information.
Sure. It's Holly Breuer. I'm at Prosper CPAs. H Breuer. It's HBREUER at prospercpas.com.
Super. And what's the best number to reach you at, Holly?
Probably our main line. I'm sorry, I'm about to lose something, just clicked here and I apologize.
No
there
problem.
we go. Okay, there we go. Sorry, my Zoom was doing something wonky while I was talking to you, Jim. I would say probably our main line. It's 314-949-1200.
All right, super. Thank you all for joining us, and I look forward to following up with. If you have a question or if you want this, we will be sending this out to all of you that registered. Feel free to forward it on to people. This is a growing webinar series. Next month, we're looking at doing one with Impact City. It's a nonprofit that we support. We're very much behind, and we'll share some ideas on what goes on in that industry and how to make greater impact with what you're doing to support the organizations you care about. Holly, thanks for joining me.
Sure. Anytime, Jim. Thank you.
All righty. Talk to you later. Bye.